At some future date, you are going to stop being in business. Whether that day comes by choice or by force, when that day arrives, your wealth will have one of three things happen. It'll continue to rise, it'll become steady, or it'll decrease. The depressing truth is that for most of you, when that day happens, your wealth will begin to disappear. To many of you, this might be shocking because you're so good at making money. It's likely that you make more money than 99% of the world population. Despite this, when you stop working, your wealth will begin to vanish. Why? Why is it that someone who's making a generational amount of income has their wealth disappear the second that income stops coming in? I want you to think back to the messaging and marketing for most of the financial industry. The ads that you see, the conversations you have, the professionals you meet with. Perhaps they sound a lot like this. Max out your 401k, or you're throwing away money. Have you read Rich Dad, Poor Dad? Are you really wealthy if you're not investing in real estate? Forget everything else. Use a defined benefit plan. You can put hundreds of thousands of dollars into it, and it's tax efficient. Is your portfolio academically sound and globally diversified? Because ours is. Bro. My buddy has a tech startup, AI, quantum computing, all in one, and it's going to be parabolic. If you're not investing, you're missing out on the future. The dollar, you're still using the dollar? Boomer move. Bitcoin is literally the future. Stock market, why are you using the stock market? Life insurance, my friend, is the no-loss tax-free provision that will allow you to have a tax-free retirement. What is the theme behind all of these messages? Their focus is on where you put your money, what you invest in. It boils down to this. Everyone in the financial industry is touting that my where and what is better than your where and what. But what if where we put our money was only a part of the financial solution to create generational wealth? What if our hyper-focus with what we invest in was lulling us to sleep, making us believe that we were creating generational wealth, when in reality, we were just really, really good at making money? To help answer this question, I've created what I call the business owner quadrant. This quadrant is going to help you identify your probability of creating generational wealth. In quadrant 1, we have owner-operator. This is a business owner who is wearing every single hat and operates in every single aspect of their business. In quadrant 2, we have owner-operator with employees. This is an owner who is still deeply involved in operations in the company, but is able to delegate some tasks to employees. In quadrant 3, we have owner-leader. This is someone who has moved all the way out of operations and is above the business in a strategic role. In the last quadrant, we have owner-investor. Owner-investors view their business as an investment and as an integral part of their entire portfolio. When I present this, oftentimes one of the first things that come to mind with people is, this is the way I view the way I run my business. This is the lens I view it through, which is a correct lens. But I've found that there's a strong correlation between the way that these owners behave and the way that they behave around the way they build wealth, the way they pay their taxes as well. So they have a lot of similarities. So with this context in mind, I want to have you go through a magic show. It's not going to be magic, but it's kind of cool because I got to reveal it from underneath the table. So I have 4 of these jars. In these jars are pebbles. These pebbles each represent a business owner in the United States. There are 33 million business owners currently in the United States. If there's any business owners in here that aren't in the United States, the data I'm about to show you, the behaviors I'm about to show you are just as applicable to you. So if there's Canadians, there's 2 million business owners, but the percentages are exactly the same. Inside of this jar represents 25 million business owners, or 75%. These business owners come from every industry, they come from every background, they come from every race and gender, etc. But they have a lot in common. Namely, not one of these business owners will ever sell their business. Most of them will not create enough wealth outside of their business to create financial independence. And very few of them will leave a financial legacy. The owners that are occupying this jar, owner-operators with employees, and even owner-leaders. In the next jar, we have business owners representing right around just over 5 million, or 15% of the business owner population. In this jar, counter to this one, these business owners actually sell their business. But it's not at the price that they want or need. It's 100% at the discretion of the buyer. Like the 25 million here, very few of these will have enough wealth built outside of their business that they're able to replicate their income and create financial independence. And the owners found in that column or that jar are owner-operators with employees and owner-leaders. The last 2 jars represent just under 1.5 million each. In the right-hand one, the one that's closest here, you find owner-leaders, and in this one you find owner-investors. Both of the owners in both jars will sell their business, and they're going to get maximum value for it. The difference between those two is that if you interviewed or sat down and talked with the owner-leader from this jar, and this jar, and this jar, you would find very little distinguishable differences between the way that they grew their business, between the way that they saved money, between the way that they invested, between the way that they handled taxes. So the owners in this jar had just as high of a chance of ending up here or here as they did in here. To simply state this, 95% of business owners are on a path to making a lot of money, but having a very low probability of creating generational wealth. So we need to look for ways to increase that probability. And the way that we increase that probability is stop doing what everyone else is doing just because everyone else is doing it. We need to shift away from being an owner-operator and even an owner-leader to becoming, an owner-investor. Because owner-investors have a very repeatable path to follow. The way that they save, the way that they handle their taxes, the way that they invest, the way that they go about their business is distinguishable and obvious from an owner-leader. So if we're wanting to create generational wealth, the solution isn't tell me what tax strategy to do or tell me what to invest in. The solution is to become an owner-investor. Now, doing that, and how do owner-investors behave, and how do I go about doing that? That would take an entire workshop, which I do not have the time to deliver to you today. But as a giveaway for you, if you come to my booth after this, and we're done with all of this, I will give you a workbook that will walk through different ways to start thinking like an investor. Here's how investors invest. Here's how investors save taxes. Here's how investors do this. And I will give you all of that. You just come by the booth and you can get a free workbook to know a broader picture, more so than what I'm going to cover in today's overall speech. But I am going to show you some ways that you can start behaving and thinking like an owner investor. And these are things that will give you permission to start taking action and start to move towards the likelihood that you're going to leave something that's going to last beyond just your life on this earth and the impact you're going to leave. So one of the first truths that you need to adopt to become an owner investor is this. The family office advising environment is the gold standard for advising. For those of you that don't know what a family office is a group of financial professionals who only work for one family and one family only. The mistake we make is believing that those financial professionals are somehow better than everyone else. The value behind a family office is not that they're better or more access to things, which they have access, but it's not that they're a better advisor. It's the environment that they've created. And that's what we need to replicate. The environment of a family office that you can replicate now, you can copy it, even though most of you aren't at the level to have a true family office on your own, is to get all of your inner circle wealth team members doing what I call the 3 C's: communicating, collaborating, consistently. Communicating, collaborating, consistently. Who is your inner circle wealth team? Someone from tax, someone from wealth management, someone from protection, and someone that deals with your business as an asset. If you can get those 4 people communicating, collaborating consistently, your entire wealth trajectory will change because they're going to open up doors for you that they never thought was actually possible for you. Now, how do you start structuring this? Because the first thing is you have to realize the family office advising environment is the gold standard. So you can implement that because you can get your people speaking. You can put them in the same Zoom room at least 3 to 4 times a year. So that's not the hard part, but it's how do I find these people and how do I construct that? Like an owner investor would, is how we're going to go through this next. So I want you to start by viewing this just like you would an organization chart within your business. You're at the head of that chart. You're the CEO, you're the leader, you're the visionary. The reason that is so vital is because too often we delegate the task of telling our advisors, tell me how big I can go, when you should be saying, this is where I want to be, this is the life I want to live, this is the vision of how much wealth I want to have, and they will help you make it happen versus them telling you what is possible. So you need to be the CEO of your wealth team. Next, I would advise that you find someone that can help you quarterback all of these relationships, that's going to ensure that everyone is talking and communicating and that there isn't any overlaps. This person isn't required, but I think it's very helpful to have someone that can be the liaison between all of these different departments. Again, it's tax, it's wealth management, it's protection. So how do I protect all of this so that it doesn't disappear? I think someone spoke earlier, Dave Asray, said he made $150 million and lost $150 million. It should be I made $150 million and protected $150 million, and then I made another $150 million on top of that. That's why that is such a needed component of your team. There's people that are helping you actually protect what you build. And lastly, you need someone that is solely focused on your business as an asset. Your business is your greatest investment. It has probably the most value and can have the best ROI. But if you ignore it or don't consider it as a part of your wealth team, it's just something over here and then I invest over here, it doesn't work as well. This structure right here, 3 to 4 times a year, communicate, collaborate consistently. This group is how you can set it up, and it will change the way you play for taxes. It will change everything that you do around your wealth just because you're talking so frequently. And you'll find that they start to feed off of each other because financial professionals are fairly nerdy and they like to collaborate, but they don't ever speak if you don't force them to. So you have to force it upon them. Now we're going to dive down one rabbit hole specifically. One of the biggest mistakes that people make is they think, okay, I have one tax person, I have one wealth management person, I have one person that helps me protect everything, and I have one person that helps me with my business assets. It's a mistake. You should have the family office mentality in each and every one of those departments. So it's not tax person, it's tax team. It's not wealth management person, it's wealth management team. It's not protection person, it's protection team. It's not business asset person, it's business asset team. We don't have time to go into all of those and show you how those are mechanically done, but we are going to go into tax because I do want to give you actionable ways that you can save taxes and make it so that you keep far more of the money that you're making. So we're going to dive down this rabbit hole. So it's important for us to see the context behind the typical accounting environment versus the way that you should be doing it at the level of wealth that you have. The typical accounting environment, one accountant. That one accountant is extremely reactive. If they're asking for your data, they're going to ask for it in January or November, December, and then maybe into January of the next year. They're just telling you how much you owe. If they happen to provide any advice, it's all going to be go buy stuff. Go buy a truck. Is there equipment you can purchase? Is there some sort of program that you can buy? It's all reactionary, it's all depreciable, and it's often things that you don't need. If they say they tax plan, and they're in this environment as one person, the qualified plan is their crown jewel. So that's things like a 401k, a SEP, a defined benefit plan. The problem with qualified plans is that you haven't saved taxes, you've delayed taxes. So at some future point, when you start accessing the money, you're going to pay taxes then. And if you're planning right, you should have more money in the future, not less. So your tax bill should be higher then than it is today. So they haven't saved you anything. The next problem with this environment is they're not helping you shift your active income to passive. Active income is taxed here, passive income is taxed here. So the more passive income you have, the less you pay in taxes. All of your insurance will be commercial. Versus if we shift to the way an owner investor would do it, it's no longer a tax person, it's a tax team. It's no longer reactive, it's proactive. You should be meeting quarterly with your tax leader or tax team, which I'll get to in just a second. Because they're so proactive, it's not longer buying stuff, you're buying assets. When you buy assets, there are assets, if you plan appropriately, that will save you taxes and be a part of your wealth journey and accumulation of wealth. The qualified plan went from, that's our crown jewel, to it's optional. This person is trying to get more and more of your income from active to passive, and this person is moving your insurance from being commercial to some of it being private. This environment has an unlimited ability to save you taxes. So the more you can shift this direction, the more you'll save taxes. But you can't shift this direction unless you've adopted the idea that I have a tax family office environment where I get everyone communicating. It's not relying on one person. So who should be on this team? This should mimic, or this is what you should have. If you don't have something like this as your tax team or department, you're paying too much in taxes. I can almost guarantee it. I can't say that word fully, but likely you're paying too much in taxes. So the tax department is going to be made up of an accountant, who you probably already have, and a tax strategist. The tax strategist and the accountant at times can be the same person, but it is my experience that very rarely that they actually are the same person. Most accountants don't have the ability to be a filer and a strategist simultaneously. So it's safe to assume on your end that your accountant that you currently have is not a strategist and that you need to find someone else to fulfill that. If you dive deeper with them and they have all those team members that I have listed on the bottom and some more, then they actually might be a strategist, but you can assume that they're not because most people can't pull that off. Those two people are who are meeting with you in the Inner Circle Wealth team. So that's your leaders of this team. They're the ones that are organizing it. It's important to note that you are not meeting with all the people in this. You're relying on these two people to lead the team for you, and they're the ones that are having the meetings. They're the ones that are planning. They're the ones that are putting everything in place. and the accountant and or tax strategist is the person that's bringing it to those conversations 3 to 4 times a year. Let's go through each of these because each of these have value. Number 1, you should have a registered investment advisor or someone that can give you access to assets that can be purchased outside of the public markets. If you don't have access to this person, you're never going to be given the opportunity to invest in an asset safely that can also save you taxes. Because public market investments do not give you tax breaks, but alternative investments, private markets can. But if you don't have that person, you're never going to be given the opportunity to partake of it. Or you'll hear about it at a conference like this, and then you'll go pursue it on your own, and you'll get into an investment where you'll lose a lot of money. That person's job is to make sure you're safely investing and saving taxes simultaneously. The next one is tax attorneys. So tax attorneys have a lot of value because they can construct the way your entities can play with each other. They can bring some more sophisticated strategies to the table at times. But if you don't have them, you're never going to be given those opportunities. The next one is a lot of you in this space, because of your medical nature, have met the criteria or can meet the criteria relatively easy of the research and development tax credit. So that's something that if you don't have a member of the team, you're not going to get it. Let me just give an example because he said I could share his story. Mike Koenigs, who's speaking right after me, right there, yeah, there he is. Hello, Mike. He got over $80,000 in R&D credits over a 3-year period. So that's a lot of money. Now, not everyone's going to get that amount, but if you don't have that member of your team, you're never going to take advantage of it because most accountants need someone else to do the specialty work that the R&D credit requires. So they need to be there. You need to know they exist, and then you have a conversation like, should we pursue this, yes or no? Other people, like if you're buying real estate on your own or buying buildings, cost segregation specialists can help you depreciate quicker. There's tax-smart insurance advisors. There's tax-smart benefit advisors. If your income rises into the close to $1 million of personal income, you probably should be having conversations around private placement life insurance and the mechanics of tax savings for you there. Again, if you don't have those people, you can't plan for it. Once you embrace the truth that the family office advising environment is the gold standard for investing, you'll never settle for anything less than a team. And that is how you save taxes permanently, is you bring in a team. You don't chase strategies. You make a team that puts it together for you. So to wrap up, I just want to hammer home this point, because focusing on taxes is a big deal. Let's just say that your tax bill is currently $100,000, but it should be, if you planned, $50,000. That's $50,000 every year that should be driven or could be driven into your business, into other asset classes, and that will start to compound on itself, and you'll accelerate your ability to create financial independence. I believe that the reason so many business owners fail to create financial independence is because they fail to save taxes, or even if they do save taxes, they're failing to take the savings and get them converted into wealth. So they just let them get spent on other things. But if you take advantage of the fact that you can save them, and you can take them and put them into assets that grow, everything will happen faster. You'll reach new levels of wealth faster, you'll reach new heights faster. And sometimes, because at least for me personally, you can have the urge to feel guilty around, am I making too much money? Is my net worth too high? Do I have enough? And it can push you from pushing bigger. But I'd like you to shift one more time between an owner-leader and an owner-investor. Owner-leaders think about, how can I get as big of a net worth as possible, or generational net worth? Owner-investors think of, how can I make the generational impact? Let me tell you quickly how I learned this lesson. My great-grandfather was a World War II bomber pilot. He was on a mission over Leipzig, Germany. This was his 27th mission. He was as highly of a decorated pilot as you could find at the time. This specific mission, they encountered Nazi resistance. 2 of his in-plane gunners died. The plane was so badly damaged that despite his past experience, he was unable to get the plane safely back to Allied airspace. So one by one, he helped his navigator, his bombardiers, his chartman, his co-pilot find their way to safety by leaving the plane. When he went to go follow them, the plane exploded. He sacrificed his life for his country, for his crew, and for his family. My grandmother was born a month later. She never knew her dad. She never knew the valor, his bravery, but the impact of his actions has carried through the generations into my soul. You don't have to sacrifice your life to leave a generational impact, but when you embrace the mindset that I'm leaving a generational impact, every dollar you add to that impact will ripple through the generations to someone else's soul. So save as much in taxes as possible. Deliberately create this team because it's the impact of what you're doing now that generations from now will thank you for choosing to have that mindset and embrace becoming an owner-investor. If you would like to have just a complimentary call around the way that we've structured this team, have built it, have manufactured it, you can schedule that here. But I appreciate your time today, and just stand up and let's get our legs going for Mike Koenigs, who'll be on next, and I really appreciate everything that you've done as an audience, so thank you.